Make this a little bit bigger. Are you poor if you're making $140,000 a year? If your kids get Trump accounts, will that help? Are prediction markets taking over investing? And for that matter, are they a good thing or a bad thing? Should you buy into the copper and silver bull market? And what are 4 stocks that you might want to check out? We'll have answers to all of these questions, this time with no tasteless jokes, we promise, on this edition of the Curia Investment Show. I'm happy, as always, to welcome my colleagues, Simon Erickson of 7 Investing and Eoin Treacy of Treacy Money, both Texans. Guys, welcome as always.
It's always a pleasure.
James, no tasteless jokes this time. That was what I was tuning in for most weeks.
Yeah, that's the thing. There's positives and there's negatives about the tasteless jokes. I'm not sure where I come down on balance, but speaking of more tasteful things, or at least employers with good taste, I'm going to share something in our fact of the day. Pardon me as I find my sharing button. Good employers outperform in the stock market, apparently by a factor of more than 3. This is according to FTSE Russell data, Great Place to Work survey. People have likened this to Glassdoor. In other words, companies ostensibly with a good Glassdoor rating outperform as stocks. Now, this feels good. I don't know how solid this data is. It certainly makes sense. And it's the kind of thing we want to believe is true. Certainly, I like to believe that good companies outperform. And apparently, there's at least some data showing that. So, fact of the day.
I would love to see that data with the Mag 7 taken out.
With the Mag 7, interesting. Because I think you're right. Mag 7 really, they shower their employees with stuff.
Yep.
But if you took that out, because what was the period, 1998 to present, right? If you took that out, I think you're right. That's a very good observation, Eoin. It might not be as rosy.
No, I wouldn't say that. Working for somewhere where you're happy and you're looked after the company, that's probably going to help to improve margins because you've got happier workers, harder working, part of the team kind of thing. I would firmly agree with that, but I would like to see a kind of a little bit more granular data.
Yeah, that was the Costco thing originally. Years ago, Costco took a lot of heat from analysts because they would spend more money to hire people and keep them for a long time. They treat their workers well. And their argument is, this is a high turnover industry we're typically in. If we can keep our people for longer by paying them more, by giving them better benefits, we're going to save a lot on HR costs because it's tremendously expensive every time you go out and you find people. You got to interview a whole bunch of people for every person you hire. So it actually, and it took a lot of heat like 25 years ago from Wall Street analysts, because I was one of the people writing about this kind of thing at the time, or editing articles about this, but they ultimately were proven right. So, all right, monologue aside, back to the matter. So $136,500 per year and you're poor, says Michael Green in a blog. He's basically some type of asset manager or wealth manager kind of guy. He's not a professional economist, well-spoken guy, but he basically looked at a 1963 formula that set the U.S. poverty line as roughly 3 times the cost of a minimal food budget for a family of 4. Economists were quick to jump on this, saying, hey, no, today food was like a third of the budget of a kind of a poorish family a long time ago. Now it's like 5%, and people are buying different things, more for their money. The standard of living has gone up. And so they essentially pounced on this guy for these formula woes. But his article still struck a nerve. Washington Post did a whole piece on it. BHG Financial found, by the way, last year, before this guy wrote anything, in 2024, that 62% of people earning $300,000 or more per year, quote unquote, struggle with credit card debt. So there is another side to this. Even if maybe we're not poor at that amount of money, it's still kind of hard. So Simon, let me go to you first. Do you think being middle class in the U.S. really is such a struggle, or are Americans just whiners?
Maybe both, depending on where you live, right? It seemed to be that, Beanie Babies were the hot thing to sell on PayPal long time ago in the 90s. And then, after COVID, it was if you stockpiled toilet paper, you could become a millionaire. Just like the necessities of life, it seems like inflation has certainly hit. And I certainly would agree that it's getting a little bit more challenging to pay for in these days.
Owen, what do you think? Is you have 2 kids, right? You were the proverbial family of 4. Simon, you have 2 or 3, is it?
2 kids. Yep.
2 kids. Okay, so 2. I have 1, but I'm the minority here. What do
Gotta
you
get busy
feel about this?
I would say, if you live on the West Coast or you live in the East Coast, 134,000 doesn't go very far. If you live in Texas, you live in a rural area, 134,000 going to sound like a lot of money. And I think a lot of your family budget, regardless of how much goes on food, how much of your family budget goes on rent? How much of it goes
Mhm.
on your mortgage today? That's what makes people feel poor. If you can't make your payment, you can't make your car payment, then 134,000 is going to sound more or less. I think that's really where they're trying to get at. It's that you've had a massive asset price appreciation, and the cost of insurance is doing nothing but rising, and healthcare is expensive. All of those things only tend to go one way, and wages don't keep up with that. So if you have to talk about 134,000 being the number, well, the problem is if everybody gets that, then the prices go up even more. So you just have to try and figure out how to be more productive, and to live within your means is something that everybody struggles with.
Yeah,
Yeah.
I think you say it well. It's a difference between maybe not being poor, but struggling to keep up with the standard of living. As we'll get to in the next story, there's been this K-shaped progression in the economy. I think we have the top 10% of people by either income or net worth doing like 80% of the spending now. And in a way, thank God they're doing that. But at the same time, there are a lot of people left behind. And if you're in a coastal area with a high cost of living, and you have a high paying job, you may come out of graduate school, with a lot of student debt. You've got to pay for very expensive childcare. If you don't want a 90-minute commute, you have a very high rent or a very expensive mortgage, if you can even get a mortgage in that area. So there are certain things now, compared to years ago, a generation ago, a 30-year-old could get a mortgage, and now they can't. That's true. It's true. The thing to add, though, is the houses are a lot bigger today. Things are nicer that we're buying, so it's not quite apples to apples. The standard of living has crept up, but it's also hard for Americans to keep up with that standard of living, if that makes sense. And I think that's probably the source of the tension with this guy's article. My own take on it.
One thing that I think is kind of misconstrued by a lot of people is that it's hard for a 30 or 35-year-old to get a mortgage. Uh, Living here in Texas, there is the T-Shack program where you get down payment assistance. So they'll pay up to 15,000. That's free money for a down payment. And on
Who
an
is they? It's
FH,
the state of Texas?
state of Texas,
Huh.
and an FHA loan is at 3.5% down payment. So, there's lots of houses out there for 300,000. There are condos or townhouses. And, if you're going to get the down payment for free, well, then it's really about getting yourself into the credit condition and managing your debt. And, maybe not buying the new car this year, buy it next year and buy a house first. And it's sort of priorities. So, yes, obviously the debt issue is clear. And, a lot of getting into a house is about delayed gratification and not spending and trying to save a bit for the 18 months before you make the purchase. And if you manage that, it doesn't matter what age you are, you can get into a house.
I'm glad you said that, Owen. It's a lot of it's maybe not hard to live in an absolute way in the U.S. and be hard to keep up with the Joneses, hard to keep the lifestyle that you want. But if you take advantage of these programs and just are willing to sacrifice a bit and accept that the U.S. has a much higher standard of living, frankly, than even much of Europe. And when I was a kid, I went to Pakistan on this mountaineering expedition with 15 years old. I was shocked. I was shocked by the poverty, but I was shocked by the fact, I was like, don't these people know they're supposed to be miserable? Don't these people know that if you're this poor, you're supposed to be unhappy? But they weren't. They were happy. And it really confused me. But it was also something that made me think, because, in the US, we see all levels of the income spectrum in a way that they didn't in that country, at least in those regions. So anyway, I'm swerving from the main topic, but I think it is hard to keep up with the Joneses in the US. It is hard to be a middle-class person, but at the same time, like, there is a bit of a false standard or a bar that we're setting culturally that doesn't necessarily have to exist. And we spend a lot of money. That's the 300K people with a credit card debt exemplifies that.
It's a good point, James. There's one other maybe interesting perspective on this, which is looking at the personal lending market, right? So this is based on what Upstart is seeing out there. Upstart is using AI and its own algorithms to make loans, personal loans to people, bypassing the FICO credit score. But they're calling the lending market right now of a U-shaped lending market, which is interesting. Those who would traditionally have a FICO score of 750 or higher, the very high end of the spectrum, seems like they're doing just fine. They're paying back their loans on time. And also the ones that would traditionally be very low on the FICO score, the other side, seems like they're doing just fine as well. They describe it as kind of that middle between, I believe it was 600 and 750, which is kind of, pretty well off, probably have a pretty good full-time employment. You maybe work for a tech company. Like, these are the tech companies that are laying off tens of thousands of employees right now, as corporate America is kind of adjusting to AI and other things are happening out there. It seems like, at least from this perspective, those are the ones that have been having more difficulty paying back the loans that they've been making, at least from Upstart's perspective.
Makes total sense. Makes total sense to me, Simon. All right. Speaking of finances, let's talk about Trump accounts. Now, each kid born, which they finally are going to come to pass, each kid born between 2025 and 2028 gets an investment account with $1,000 added to it. Recently, Michael Dell and his wife, billionaires, are giving $6.25 billion to give $250 extra to kids under age 10 in zip codes with median incomes below $150K. Now, as I understand, with the Trump account, you can't touch the money until you're 18, save for education and a few other exceptional things. And at that point, it becomes an IRA. Parents, as well as benefactors, can donate more money. And that's the hope, that the parents or somebody will give more money to these kids. So, Eoin, let me ask you, with this preamble, the K-shaped economy in the U.S. we just mentioned has really, I would say, shown us the difference between owners and workers. Now, proponents of this stuff say the Trump accounts at least start to make more kids owners. And as Michael Dell's generosity illustrates, these accounts provide essentially a direct to beneficiary way to make charitable donations without the big bureaucratic bloat of some middleman charity. You can actually just give kids money in whatever state or region or across the U.S. you want. Now, opponents say, well, this idea won't really help wealth inequality that much, and maybe that these poor kids need the money now, not when they're 18. Where do you come down on this?
Well, my daughter actually benefited from a program just like this in the UK when she was born in 2006. The government gave a kind of a good start, £250 to every kid. So she's got to kind of dig that up. I put that in BHP Bulletin back in 2006. So we'll see how that's done since then.
Was that a James recommendation? That might have been a James income.
It probably was. Yeah,
okay,
yeah.
okay.
I'm going to check the stock price.
So, but she'll have to dig that up. I've met several people, I would say really in the last 2 or 3 months, that they put money into their kids' account back 20 years ago, one in Apple, one in Microsoft, and they've done exceptionally well by just never touching it. So I think we're at this sort of interesting environment here where you're really putting money into people's accounts and telling them they should invest it. That it's really trying to teach people that money in the market, it's time in the market, is the thing that really helps to generate the big returns, and particularly in a big bull market. And putting that cash into people's accounts, well, yeah, kids need it now. There's no question of that. But kids will also need it in the future. There's never a time in your life where you don't need free money. And if you have third-party benefactors that are willing to give money to kids in the country, what's wrong with that?
Yeah. And by the way, if I'm your daughter, I might be complaining just a little bit, Eoin, because BHP Billiton it's not, I want to say flat since 2006, but it's up modestly. It's up modestly, but at least she's got something. At least she got some gains. I'm just looking at the chart here.
No, that's your full disclosure. They're not all good recommendations.
That's how it is, though. I like this idea very much. I mean, personally, I think the name is a bit cheesy, but it was probably necessary to get this thing through. I sometimes use a stat when I give talks that if you took a baby and gave that baby $500, using the historical growth rate of the S&P 500, by the time that baby is 70 years old, that $500 put in an S&P 500 fund would be worth almost, or at least close to $500,000. So compounding is just tremendously powerful. And generally speaking, if you want to get rich, you got to own something. It's very hard to get rich, not impossible, but hard to get rich through salary alone. And so by seeding these little accounts with these kids, they're at least putting the getting the wheels turning, let's say. I think even with moderate gains, with no added money, the $1,000 is probably going to be worth about $6,000. Somebody estimated by the time these kids are 18, and if their parents or families or benefactors add more, they could be worth substantially more. So I'm all for it. Some people think this is a backdoor way to start privatizing Social Security, which I wouldn't be against personally. Well, that's a separate topic. So yeah, I'm all for Trump accounts. This is a great idea, and I think it just makes a very efficient way to donate money, as Michael Dell is demonstrating. So
I think though, anywhere that privatizing Social Security has been tried, it's worked.
yeah. I think it worked for Chile a while ago too. That was one of their
And
strong arm reforms at the time that paid off.
It's been a fantastic system for Australia.
Yep. All right. Totally shifting gears. Let's talk about prediction markets. Do most investors really want to own a business, or do they just want something that'll make them money? We're starting to find out. Kalshi and Polymarket have exposed a regulatory weird spot. If you make a bet on something like a sports game, on a state level, that's regulated as gambling. But on a federal level, your bet is kind of akin to a futures or a forward contract, similar to two people betting on the price of corn or pork bellies, and it's regulated by the US CFTC. This issue is not legally settled, but Kalshi went first with the position that it's not a state purview gambling house. It's more like a prediction exchange to be regulated by the feds. Polymarket followed. We've got DraftKings, Robinhood, Crypto.com, and some others lining up. Simon, I'm going to come to you first on this. I think just to frame this, I think this calls to mind, at least in my mind, two categories of questioning. You may have more. One is just legally, mechanically, with some states like Nevada and Connecticut challenging this. Connecticut has a cease and desist on these guys. Is this going to fly legally in the long run? Second, more big picture, if it does, is this good or bad for humanity? People are gambling instead of investing. Insider trading is not so illegal in these markets. You're a fan of DraftKings, which is getting into this, and I think correctly you're anticipating this trend. But what do you think, DraftKings aside, about this trend?
Those are good questions, James. And I'd like to start just a bit upstream of those, because it's a good question of, is this legally even possible? Is it going to fly? And what's the impact to society? Those are good questions. But maybe we start by why is this a big deal and how do we get here? For anyone who's been to Vegas, the fountain at the Bellagio is beautiful, right? The Caesar's Palace shops are incredible. Basically, every casino you go to, you get free drinks. Why? We all know why. Because the house always wins. You're never getting even odds against the house, except in one bet in all of Nevada, which is behind the pass line of the craps table. We can talk about that separately. But anyway, the house always wins because it has superior odds, and you're getting inferior odds as a gambler. And so this move from the Las Vegas Strip, which had the largest casinos, right there where the traffic was, to FanDuel and DraftKings becoming the oligopoly, that those two companies alone had 80% market share of online sports betting, right? You would just use it through the app. It was very highly complex and regulated. You had to have the capital to provide for things like there's for a variety of reasons. There's a Bellagio and a Caesars of the online world as well. The catch is you're still playing against the house. Most of these bets that you're making, even with DraftKings, with the other online sports platforms, you're still betting at inferior odds. Even if it's a 50-50 bet, it might be minus 110 for the favorite. You have to put in $110 to get $100 out. And it still was these companies keeping, about 10% of the handle, 9 to 10% of the handle for themselves. They were still raking up dollars and cents every single quarter that they'd report on their conference calls. They'd say, hey, our revenue, our earnings were this much per year or per quarter. That's because the people that were betting were not only losing more often, but they were also the house was always winning. This is important because this is vastly different, James, than what prediction markets are doing, which is not when you're placing a bet in prediction markets like Polymarket, Kalshi, or even the new ones that DraftKings is going to introduce. You are no longer betting against the house. You are betting into a pool that is peer-to-peer, real-time financed by other competitors. and it's reflecting the true odds of where all the money is going. You're seeing it almost as a percentage, or they're thinking about it in terms of $1 per share. 92% would be 92 cents of the dollar payout that you would get. And it's kind of providing not only a more fair way of pricing these, where the house isn't always taking 9 or 10% right off the top, but also kind of giving some interesting insights to how people feel about things. So maybe my first comment as we dig into this a little bit deeper, James, is that this is fundamentally different and disruptive to how we've traditionally done gambling and sports betting.
And so let me ask you this: if it's not really the house, it is. And first of all, I'm glad you stepped back and provided that overview. It's hugely relevant because it is a different thing. What does the house take in? I mean, they're doing this not for free, right? What's the overall transaction cost of this prediction stuff?
That depends. They're typically making right now, at least for Polymarket, and I think the competitors are similar. They're taking 2% of winnings, and then similar to an exchange, they're also taking between the bid and the ask. So it's a bid-ask spread that they're taking, more like an exchange would do rather than a house or a casino would do.
Got it. So that's still, just strictly speaking, compared to stocks, I mean, it's better than the house thing, right? Better than 10%, but it's still a pretty big spread they're taking.
And the interesting thing is that a lot of them are built off of blockchain technology, where you're actually using USDC, stable coins, or even in some reasons, Ethereum or Bitcoin to place the bets. I think that's where the regulators have a real problem with this, James, because sports betting, or if you're in a casino, you could really regulate that on a state-by-state basis, right? You knew Simon Erickson was walking into Las Vegas and was placing these bets in a place where it was legal. That's not really true with cryptocurrencies, where kind of the key selling point of having these was the anonymity aspect. There's a lot less of a regulation that you can have on things like that.
Interesting. So, Owen, I'd like your views too on this, like in terms of the philosophical argument, because I guess nobody really knows if it's going to be ultimately legal or not. We'll see the courts battle that out. But if you take a securitization, for example, which is a creature of the past couple hundred years that really made a difference, right? Instead of a couple of guys with a lot of money getting together to buy a company, you can chop that company into tiny little slices and sell it to all the common men and women in the world. And it's been a great innovation in finance in so many respects, but you're a part owner, right? You're a part owner. You get to choose, do I want to give a good company more capital? You're not giving the company capital directly, but if they do a secondary offering later on, maybe you will be occasionally giving them capital indirectly. You're enriching them through stock options to driving up the stock price. In other words, it provides a feedback mechanism to the market that the gambling or the prediction market would not seem to. That's one step removed. What do you think about that, Owen?
Well, I think one thing that is, I think, fairly clear is, people are now looking at Polymarket to make their investment decisions. So, if they want to buy Apple, they'll go to Polymarket and they'll look at, well, what are the odds that Apple is going to be up in a day or in 2 days or 3 days? And then that will help to inform their decision. So from that respect, it's live market intelligence. You can use that as a way of thinking about political outcomes, weather outcomes, and the wisdom of the crowd and how people actually move their money. That is often a very good predictor. Now, of course, there is also the other, that when you get to a 99% and everyone is convinced of it, well, then the optionality is to take the other side of that, because if the crowd is wrong, then your payout is going to be enormous. So there's that. Now, something though, if we want to go really big picture, you have to go back to the 1920s, when highly leveraged trading was the norm in the USA. And the reason why futures are so heavily regulated in the USA is because everybody lost their shirt in leveraged trading during the 1929 crash, and it caused the Depression. So, when we see these sorts of quasi futures turning up, the number one thing about a futures contract and leverage is you can lose more than you put in. And one of the reasons why options are not as severely regulated in the USA is because you can buy an option and your loss is limited to how much you pay for the premium.
Mm-hmm.
But this is going to be, I think, the big question for the CFTC is, when we look at these kinds of betting and futures type operations, will you be able to lose more than you put in? And if that is the case, they will be shot down.
Yeah, I guess that's the beauty of just a responsive system. We can see how they work, for society. Are people who don't understand them going in and getting themselves blown up? If that's the risk, I don't want that on a big level, right? And hopefully the U.S. doesn't want that either. So hopefully, if people are using them responsibly and in right, fair quantity, that'll be allowed to continue. If they're causing trouble, they'll be more regulated.
And
One other
Go
thing is that in the UK they have something called spread betting, and they're also called contracts for
CFDs,
difference.
yep.
Now, there's two things about that. It's that about 80% of people lose money, so that's one, and they don't tax winnings, because if they taxed winnings, they would have to allow you to take a write-off against your losses, and because more people lose than win by a large margin, they would actually
They would hurt
lose
themselves.
money.
Yeah,
The
yeah.
taxing entity would lose money if they taxed you on your winnings. Now, if that is what's going to turn out to be the case in Polymarket and Kalshi, well, that's going to be very interesting.
So if you could blow up CFDs, would you? I mean, are they bad for British society?
No, I don't think so. I think, look, we're adults, and if
Yeah.
you have if you want to have a decision and you want to try and make some money out of the market, well, approach it like any other decision. But I think adults are adults, and we should be responsible for our own decisions.
But reading between the lines that answer, it sounds like you kind of you would mentally put them more in the gambling bucket. And even though the websites look like regular brokerages, do you consider that more gambling than proper investing?
Well, no. If you approach it as a gambler, it's gambling. If you approach it as an investor and you use money control discipline and you start to be a bit more ordered and and think about what you're doing, well, then it's investing.
Gotcha. So it's how you use it. If I use Drano to clean out my toilet, that's great. If I drink it, it's a poison, right? So it's all about, I don't know where
That's
that analogy
all
came
on you.
Yeah, not
It's the next
tastelessly. Weird, but not
Look,
tasteless.
philosophically, the itch is always going to be there, right? Whether you're rolling dice
Yeah.
in the alleyway, or you're buying Bitcoin for speculation, or you're going to the horse track, or you're online gambling, it's always going to be the itch of speculation versus investing. We should draw the differentiation right there. Speculating in things like this, of, how many times Trump is going to say tariff the next time he speaks publicly, versus investing Apple and holding the stock for the next 10 years. This is different fundamentally than investing. But I think that philosophically aside, is good for America, is bad for America. This is about money. Right? This is about money. This is for the states that have legitimized online gambling. It's because they're getting taxes from it, right? They are taxing. There's some states that are charging 50% plus of winnings. You have to pay more than half of your winnings as taxes back to the state. And of course, Las Vegas and Nevada don't want to have this happen. They want to have all that revenue coming into their state where they can regulate it and they can earn the tax revenue from it, rather than being at the CFTC at the federal level, where it's also very hard to track where the people are even located. I'm not surprised at all there's pushback on this from a regulation perspective, but I do think it's going to happen. It's already happening right now.
Yeah, 50% winnings tax basically screams gamblers go away to me. I was taking my son to school a little bit late this morning, and he was texting with his friend. He's like, "Oh, my friend is day trading in the class," and he just showed me his, his money. I have mixed feelings when I hear that. I think it kind of summarizes what's happening a lot with younger people in the U.S. here.
But was he up?
It sounds like this guy was up on this day. That's why he was sharing it with his friends, right? But I'm not sure that he shares his down days, and I'm sure he does have some down days. It is great that this young guy who's probably 16, is getting into this. That's a win. But at the same time, as a fundamental investor, traditionally, I get a little scared of people mixing these two. And I think, unfortunately, for better or for worse, for a lot of especially the younger generation, they kind of see it all as one blurry thing: investing, gambling, whatever. Yeah, it's more gambling to them, and investing is just a way to do their gambling. So I don't know, maybe they'll mature, maybe things will change. We'll see what happens. I don't think the sky is falling. I don't think things are going to blow up immediately from this. It's just a little bit of a potentially scary thing.
And one other comment on that potentially scary thing is be expecting manipulation. I mean, this is like the hotbed for bots and fraud, and it's very unregulated, and the bumpers are not in place yet. I would say buyer beware before you get into any of these prediction markets. Yeah,
and I think there are very limited insider trading rules because of just the nature of these things. Traditionally, a farmer hedging his wheat or whatever, he might have had insider information because he had some huge farm, right? About, how much volume is going to come to the market. And so it just wasn't practical to have these rules. but now you're having these instruments on stocks and share prices and other random things that may have traditionally been more insider information phobic. So we'll see how that shakes out also. But moving along. I went back to you as our resident commodities expert. You've written about silver and about copper in your newsletter recently. Gold has been the big story over the past month or two, $4,000 an ounce. There's a big psychological point. Foreign governments now hold more gold than they hold U.S. treasuries, which says something about the dollar. But you've been talking about silver and you've been talking about copper and their use in solar systems and in this LME COMEX arbitrage. Can you unpack what the story is with an eye to the investor who maybe isn't deeply familiar with this?
Okay, so copper is a commodity that's used everywhere and in basically everything. And it is often called Dr. Copper from a market's perspective, because when copper is doing well, it usually means that the global economy is doing well because it's used in everything and everywhere. When there's more demand for it, it means that people need it and they're doing economic kinds of things. Now, I call it a Chinese doctor because 54% of all the copper used in the world goes to China. And then they also refine about 60% of it. So it's really the movement in the price is a lot to do with what's going on in China, and the economy over there is not great right now. But then we've had the price, which has been going sideways in the London Metals Exchange. That's the primary area for trading copper. And then there is also a future traded on COMEX in Chicago. Now, that's the US price of copper. Well, with the threat of tariffs, with the trend towards nationalization, what has effectively happened is that there's now a difference between those two prices. And the US price is more expensive. Now, that is deliberate. That is a clear trend of policy to try and make it more attractive to build refining capacity in the USA in order to further the aim of resource nationalization or nationalism. So that's part of government policy, which is pushing up prices, because now with a higher price in the USA, it's attracting the copper from the rest of the world into the USA to harvest that price.
So you said
So
it's
now,
deliberate. How are they affecting that deliberateness?
well, basically, they've introduced not a full tariff, but a partial tariff and a threat of tariffs. And now you're starting to see the inventories on COMEX. They are now at an all-time high. So that's a rather significant factor. Now, with silver going up and really rallying very impressively, it's now broken up through $50 and it's continuing to hold that gain, and a lot of bullishness around that. Well, the most important thing to remember about copper is that it is a precious metal. It's often referred to as high beta gold, but it is also an industrial metal. And the primary use for it now is in solar panels. And in solar panels, it represents about 10% of the cost of production. And that figure was accurate about back in June. And since then, silver prices have gone up in a material fashion. So now it's turning into a really cost push issue for the solar panels. Now, the reason that it's in solar panels is because silver is a wonderful conductor. And of course, the other big conductor is copper. So there are efforts underway for thrifting so that they'll try and use less silver and replace it with copper in future solar panel designs. And if that's the case, it's going to create a demand driver for those copper prices. And that's why copper miners are doing well.
Do you think silver and copper are fairly priced now, or would you be an active buyer at these prices? They've run up quite a bit. Let me see if I can bring a chart up as you're
Well, I think
replying to that.
the important thing is that you look at the ratio, because right now silver is at on a relative basis, it's more expensive than at any time since 2011 compared to copper. So copper is probably where you're going to see the greatest upward pressure if we start to see a thrifting effort. Now, I have to say that we are not yet seeing that kind of innovation. There's certainly been a lot of investigation into trying to create new solar panels using copper instead of silver, but they are not in the market just yet. But At the same time, I think copper prices are now coming out of a very long period of really doing nothing at all. So I think that is where we're going to start to see some value coming through.
Yeah, this is the 1-year chart I have up here. And let me just ask you this, Owen, and maybe this is showing my ignorance, but this is COMEX price. In it looks like the very end of July, July 31st, there's this huge, relatively big drop in copper. Is there like a story behind that, or just something that happened?
So yeah, that was the rise up ahead of the Trump decision on the tariffs, and then it dropped back down because the tariffs were not as bad as was
I see.
initially expected, and now the price is moving up again simply because there's a tariff at all.
Gotcha. So Trump tariffs are good for copper, basically.
Yep.
All right. So let's conclude with some stocks that we're looking at. Simon, I've seen you contemplating and nodding throughout that last discussion. So I'll let you go first with your stock.
I'm going to go with Skywater Technology.
Ooh.
James, the ticker on this one is SKYT. It is a small company. It's a technology company. They call it technology as a service. They're basically helping chip makers design innovative new chips and then get them manufactured within the United States. So that's a huge demand driver right now. We want to reshore a lot of manufacturing of chips. If you are NVIDIA or AMD, you have no interest in this. You are designing them yourself, and then you're hiring Taiwan Semiconductor to manufacture them at scale. But if you're a small company who's got a really innovative design for a quantum computer chip or something that's radiation resistant for an aerospace contract or anything else that that would be smaller quantities but still needs to be very innovative, this is where Skywater really competes. And they just bought a new fab from Infineon in Austin. This is a company that is kind of off the radar of most of investors, but I think it's really interesting right now. I kind of like the model that they've got, and they've got really good growth. Maybe worth a second look.
I noticed they have a PE of 7, at least on Google, up 125% in the past year. Is that just because like a one-off? Is that a one-off number, or is that just legitimately really cheap compared to everything else?
It's not organic. It's acquisition that they just had, for this fab that had a lot of pre-existing customers that they're trying to offload and have it be more of a pure play. But a lot of that was related to the contracts that they had for the previous fab.
Okay, so there's stuff going on, basically. All right. Owen, what is on your radar?
Well, I have been paying attention to the auto sector, and I think that we're seeing now is that the brakes are coming off. So
Nice.
I kind of I look at Stellantis. So
Okay.
now what we've seen just in the last couple of days is that fuel efficiency standards have been reduced, and we've already seen that the subsidies on EVs have been removed. And I think this is really trying to encourage people to buy, and getting people to buy is a lot easier now when you have the president talking about allowing people to write off the interest on their auto loan against their taxes. So this really helps to emphasize that the government and the American dream is not just about home ownership, it's also about funding your truck purchase. This is, I think, a share that has further to go on the upside. It's very depressed, and it only just broke out this week. So I think that there's plenty of upside here in some of the automakers, but particularly some of the truck manufacturers.
The American dream is also about funding your truck purchase. That's a wonderful tagline. Oh, and if you're a truck company, I like that very much. So Stellantis down 7% roughly in the past year, but you're saying with the regulatory changes coming and perhaps just some new investor love, it may be time to hit the brakes on the EV stocks and push the accelerator on just a regular car company like Stellantis. Awesome. Okay. We have, again, our analyst, Shaoping. Are you? Oh, I unhide, sir. Are you there, Shaoping? And you've got a stock you want to share quickly, I believe.
Yeah. So today I'm going to talk about Copart. The ticker is CPRT. This may seem not that exciting, but it operates the world's largest online auction platform for salvage vehicles. The car insurance company declared those losses after accident, but like behind the scenes, Copart is more like a powerhouse. It's capital light, logistic driven global marketplace with operations in more than 190 countries, over 250 facilities, and more than 1 million registered buyers.
So if you wreck your American dream truck, basically, your insurance company buys it. They give you the money for the new one, but then they take your wrecked truck and they sell it to whoever wants the pieces via Copart. That's what they're the middleman in that transaction, right?
Yeah. It has something. So its mode is something that it's really hard to replicate. It's stolen and deeper buyer networks and in a very efficient operating model. And its financials is also really impressive. Copart has no debt, generates nearly 1.23 billion in free cash flow, runs at 36.5 operating margins and 22% ROIC.
I like ROIC. So you're persuading me already. Even we can't see you, incidentally. I don't know if you're just hiding in the dark today, the ninja of this broadcast, but certainly a lot of good data. PE ratio of 23.7, which is a bit below the market. I think the S&P is 29 or 30 now, so it's cheaper than the average stock. It's a boring, gritty industry. The market does not like this stock this year, down 39% almost this year, even if it's up the past 5 years, barely 38%. So basically, this is like a left behind company that everyone wasn't focusing on when they were watching AI. Is that fair to say?
Yeah. And it's currently trading at around 25 times forward earnings. So it's cheaper than the S&P 500. That's
Got it.
Yeah.
Nice. All right. So Copart. So when you buy your Stellantis, if you want to capitalize on wrecked Stellantis, you can buy Copart. So let me. Am I still sharing my screen or not? Okay, I'll give my stock here. I'm going to go with Campbell's Soup as a stock.
That's brave of you.
Of interest. Okay, a stock of interest. Let me first show the chart here. So down 31.6% over the past year, down almost 40% over the past 5 years. You may be, PE ratio of 14, dividend yield of 5.35%. So of course you're wondering what's going on. James, why do you like Campbell's Soup? I can say a couple of things. First of all, it's back to its 2008 financial crisis price. There is a recent event that happened around Thanksgiving when I think their head of IT was taped yelling at some other guy talking about, hey, they make I'm not going to say the word for effing poor people packed with artificial ingredients. Who buys our S? And called some employees in India idiots, claiming they were selling 3D printed chicken, which they're apparently not, the company says. So this was not good for the brand. I mean, he does have some points. They're not selling to a rich customer. When I was a kid, we ate Campbell's Soup all the time. It was just a more common thing to eat in the U.S. Standards of living were lower, but nowadays soup share has been declining 1% or so by year. So it's not a growth category. It's kind of a flat to slightly down category. People just don't like it that much. It's somewhat processed, relatively high in sodium. Campbell's does own Goldfish, which has been a little better. This Rao spaghetti sauce, which is their hot grower, like 20% a year. Prego, Swanson's, most of the stuff they've got is flat to low growth, not an attractive business, but at some point the price can make an unattractive business attractive. So with this negative ding lately, I'm just wondering, is it time to scoop in and do a value purchase on Campbell's Soup? So, okay, that's my pitch. Shaoping, any questions you disappeared again, Shaoping. Any questions from the audience, or we just wrap it up today?
The question, one question from Isabella. If you had to pick one metal today, gold, silver, or copper, where would you put your money in?
I think we're looking at you, yeah.
Personally, if I had to put money in today, I would still like to own gold. I think that is the one that's below its peak. That's the one that's consolidating. I don't have much fear of a big drawdown. The only reason that gold is going sideways when silver is going up is because the Russian central bank needs the cash. So they're selling some of the state gold. That's the only thing holding back gold. When they've finished selling, then it's going to start going up again. I'd rather be buying a dip than chasing new highs.
Gotcha. So Isabella, there's your answer from a guy I think we all trust. Guys, thanks so much. Always fun to do this. Thanks for watching us. Eoin Treacy of Fuller Treacy Money, Simon Erickson of 7 Investing, Analyst Shaoping Huang, who popped on briefly, almost cameraless, to give a stock pitch. Thanks so much, guys, for joining this. And thanks to you guys, as always, for watching us at home.